Hello to everyone that's jumping on. Welcome to NCST's Community Impact Briefing. We'll get started here in just a couple of minutes. Again, if you're just jumping on, we'll get started here in a couple of minutes. You are in the National Community Stabilization Trust's Community Impact Briefing, and welcome. I'm going to give folks just one more minute to join. I still see folks logging in and want to give them the opportunity. All right, we'll go ahead and get started. Welcome again. My name is Erin Persons, and on behalf of my colleagues at the neighborhood at NCST, the National Community Stabilization Trust, I'd like to welcome you to our March Community Impact Briefing. Happy St. Patrick's Day to those of you that celebrate, and we're glad to have you here today. Today we have an exciting lineup for you that includes a lot of information about upcoming legislation, the Neighborhood Homes Investment Act, that is very important for communities. We also have a policy update from our president, Julia Gordon. As a reminder, we will have questions and answers throughout the presentation, question and answer time. You can either use the chat or the Q&A feature if you'd like to ask a question. In addition, please feel free to raise your hand and I'm happy to unmute you if you'd like to ask questions directly. With that, I will turn things over to Julia Gordon to introduce our speaker.
Thank you so much, Erin, and hello, everybody. I hope everybody is doing well as we are finally coming around to spring and those vaccines are starting to get out there. I have the honor today of introducing our colleague, Chris Siglin. Chris is NCST's Vice President for Policy and Partnerships. She comes to us with an incredible background in housing policy generally. She has worked at two of the leading nonprofits in this space, the Housing Partnership Network and Enterprise Community Partners. Before that, she served as the policy director of the Millennial Housing Commission, which was a bipartisan commission examining the nation's housing policy across all the different areas. And she also worked on the Hill, both on the Senate Banking Committee as well as on the personal staffs of some members. We are delighted to have Chris with us at NCST because she brings such a great breadth of knowledge about so many different parts of the housing and community development space. And I think in recognition of her role, she has, she's been really successful in some of our coalition efforts. And today what you're going to hear is about one of the coalition efforts we've been running around the Neighborhood Homes Investment Act. And she'll talk specifically about that piece of legislation and what it might mean for you. So with that, Chris, all yours.
Thank you so much. And I'm feeling lucky to get to talk about one of my favorite projects I've ever worked on. So if Erin could put up the slides, we're going to walk through how this law works and how it will help direct resources to single-family developers working in neighborhoods suffering from the value gap. And I'd like to start with one of the more unusual slides you'll ever see. Next slide, please. This is the broadest coalition I've ever worked on. Any of you who follow politics will notice that the National Community Reinvestment Coalition and the American Bankers Association usually don't both back the same bill. So you also have, of course, NCST, which leads this coalition, LISC, Habitat for Humanity, but you also have the Mortgage Bankers Association and the National Association of Realtors. So and in civil rights organizations, Unidos US and the National Urban League. So this is a robust, broad-based coalition. And what are all of these people working together on? Next slide, please. This is the problem. All of you, many of you work in markets where to fix up a house and get it into the kind of shape that would make a family want to buy it costs more than the home can be sold for. So that valuation gap discourages mortgage lending, it discourages investment, and it ignites a cycle of blight and disinvestment that we're all too well familiar with. This is not a problem that's going to get better because we're building fewer homes than we need in the United States, and there is an increasing amount of the housing stock that is 50 years old, and it drives vacancies because if a family can't qualify for a mortgage for a home because it doesn't appraise, then that just drives, again, the cycle of blight and vacancy. So next slide, please. So there is actually legislation pending in Congress that addresses this issue, and it's been reintroduced in the 117th Congress, and we're actually up to 10 co-sponsors. In addition to those that you see there, we've added Senator Stabenow from Michigan and Senator Moran from Kansas. And you'll notice something unusual about this list too. Look, it's evenly balanced between Democrats and Republicans. Again, that's not something you usually see, but it's a good sign. On the House side, the bill had been introduced in the former Congress. They are waiting on reintroducing it in the House, but it actually was included in a proposal from the Tax Writing Committee on the House side in this Congress. So we think that's a good sign. Next slide, please. So what this is based on a group of people who were thinking about how to solve this problem of driving investment to dilapidated single-family homes, looked at the success of the low-income housing tax credit. And basically, this is a new federal tax credit that would be allocated by the states that would drive investment into single-family neighborhoods. Next slide, please. So the state, it works just like the low-income housing tax credit does, in that these tax credits would be allocated to the 50 states, and in most states, the agency that would be chosen to administer this would be the State Housing Finance Agency. It's a significant amount of resources. It's about $2 billion a year, so that's not insignificant. Next slide, please. So the states, just like they do with the low-income housing tax credit, the states would write up an allocation plan. So they would, for single-family rehab, you all know this, for single-family rehab to work well, the homes need to be clustered in a neighborhood. So there's provisions there that the states should write allocation plans, and they should select priorities. They can choose green building, they can pick revitalization areas. then the people who receive these allocations then can use it to raise equity capital from investors that will go into the homes, and I'll walk through the details of how that would work. And then the investors can claim the credits when the home is occupied by an eligible homeowner. So next slide, please. So one of the things that's really important about this, and we'll be showing you maps, is this can only be done in areas that need the investment. What wouldn't be helpful in our current overheated housing market in a lot of places would be to have this just be done far and wide. It could just drive up home values. What we're trying to do is drive up home values in areas that need the investment. So the poverty rate has got to be 130% of the area poverty rate. Median family incomes are lower. Median home values are less than median. So this is about 24% of the United States qualifies. So that's that seems about right. And there is some additional flexibility to use these credits in rural areas, because in some rural areas, incomes are so low that we had some state housing finance agencies look at it, and they wanted the flexibility to use it more easily in rural areas. There's also some provision to use it for owner occupants in gentrifying census tracts, because again, if somebody has hung in there in a neighborhood where values are going up, you want to keep the existing residents. The states can develop some additional criteria. And these would be allocated competitively, just like the low-income housing tax credit is. Next slide, please. So here's a map. This is the state of Georgia. And you can see that the areas of Georgia that are marked in blue are census tracts that meet all three criteria in the bill. So next slide. This is the city of Atlanta. And again, any of you who are familiar with Atlanta know that the wealthy areas in Atlanta are in the northern half of the city, and those areas aren't eligible, but quite a lot of the city is. Next slide, please. So you can actually look at these maps and look up your city and any place you work. Go to we'll share this presentation, but go to the website and hover your cursor on that black box, and it will come up an interactive map that you can type in either a state or a city or a congressional district, and you can see which census tracts would be eligible. Now remember, just because the census tract is eligible doesn't mean that somebody would be allocated credits to be used there, but it tells you the geography that's eligible. Next slide, please. So you can do it. It's only single family homes. There is, but in cities that have stocks of duplexes and triplexes, this can be used on that. And there's three different ways it can be used. It can be used new construction for sale. So if there's a vacant lot somewhere and someone wants to build a house on it, and the house would cost more than it can be sold for, you can use it for infill new construction. You also can use it for substantial rehab. I'm guessing that is probably the largest use there'll be for this. But an important feature of this is it also can be substantial rehab for existing homeowners. You know, it's important to help that person stay in the neighborhood when investment starts going on. So we figured out how to make this work to keep existing homeowners as well. Next slide, please. So that there are restrictions on both the income of the people buying the homes or staying in the homes and the maximum home price. Because again, you don't want the stories in the press about, you know, rich lawyers using this to buy houses in gentrifying neighborhoods. The next slide, please. And it's a shallow tax credit. It's only 35%. So of total development costs with an absolute cap. There's an outer boundary, and then it's the lesser of, and it's 35%. And one of the, actually NCST's data contributed to the $20,000 minimum rehab per unit, because that's about what NCST buyers were spending in some of the states where NCST buyers have been really active. So next slide. And so I'm going to be able to walk through some examples. So I think this will make more sense when you all look at an example. But the credits are claimed by the investor when the home is complete and there's a homeowner in there. So it's not, this isn't going to be like, we're hoping that this has lower compliance costs than the low-income housing tax credit, because there isn't a 15-year period where it needs to be rented out. And we don't want this to be used for houses to be flipped, though. So that if the homeowner sells the home in less than 5 years, half the gain will go back to the state on a sliding scale down to, in year 4, it would be 10%. So next slide, please. So, the protections against gentrification with this are that, remember, it's got to be in census tracts that have median home values that are below the area median. So a market where it's starting to heat up probably would have an above median home value. The homeowners, this will allow some income mixing in neighborhoods, because homeowners can go up to 140% of area median, but there's obvious reasons you don't want that to be uncapped. The home sale price is limited to 4 times area median, and there's an outer boundary based on 80% of the national median new home price for the eligible basis for credits. So all those things are ways to make it, to protect against gentrification. Next slide. So this is an example of how this works. So this is for that home on a vacant lot. So you get the land for $40,000. The home costs $200,000 to build. So you've got total development costs of $240,000. Now remember, the tax credit is 35% of the total development costs. So that's the maximum tax credit you could be eligible for. But what's interesting with this program is that you actually only get the tax credit for the amount of the gap. So there's this outer boundary of how much credit you could be eligible for, and then the developer will find out how much credit that they're actually going to get for their investor when the home sells. So in this example, the gap is $50,000. So that is the amount of the tax credit. So this is a feature that will enable the people who get allocated, the managers of these credits, if the homes sell for more than they thought, they'll have more credits and they can do more houses. So we're hoping that this ignites a virtuous upward cycle of reinvestment in neighborhoods. So next slide, please. This is a rehab example. And again, so many cities in America, the home values don't support the new foundation, the new roof, the new HVAC that a house needs. So this is got rehab of a house, and the total cost of it, the total development cost is $120,000, but the house only sells for $100,000. So you've got a $20,000 credit that fills that gap. Now the maximum, that if the house would have sold for less, that house was eligible for a credit of up to $42,000, but they only get the credit for the amount of the gap. And again, if the nonprofit, for-profit developer is doing well selling the houses, they're going to have more credits to do more homes if the market starts to stabilize. So next example. Now this is that homeowner rehab example. And on this one, there's not a sale because the person is in the house. And many times these homeowners have already paid off their mortgage, but they can't afford the repairs on their home. And so this is how this example would go, is it costs $100,000 to fix up the house. You get a credit of 35% of that amount. And then the balance of the cost for the repairs could be covered by either, if the homeowner's in the place to afford a mortgage, they might refinance the house for the balance, or they might get a grant from the city, because there's nothing that prohibits this from being used with home and CDBG. So that's how that would work. Next slide, please. So these are estimates of outcomes over 10 years. And I'm seeing a bunch of questions in the chat. So let me pull them. Here's a question about, here, let me read this question. Michael Roberts from Housing and Education Alliance of Florida. Foreclosures are down and more vacant properties in 2016. Why? And further deep dive into the whys. Could it have anything to do with the housing crash of 2008 and how the delinquencies were handled on the modifications which were put on the back end of the loan, putting we put on the back end of the loan, putting so many homeowners upside down and homeowners having no incentive to sell or stay in the house. Well, yeah, that's right. I think there's not a lot of policymakers who would think that the way the foreclosure crisis was handled in 2008 would be the way that we would do it again. And I think some of the intention between the NHIA is to try to help protect homeowners' equity so that they benefit from having owned the home over time. And Jason, do you want to, Erin, would you unmute Jason's mic so he can ask the question?
So I don't know that I can, I'm not able to see that I can do that unless I stop sharing, Chris.
Okay, well, let me just go back in the chat. And then Jason Jones says, could it be considered to cover 110 to 120% of the gap so that the discount rate doesn't lead a loss to the developer? And I think the answer is that as this program is developed, people are going to create, the credits will probably, you will probably need more credits to do this in the early years, like what happened with the low-income housing tax credit. And then as people become familiar with how it works, prices get bid up. I think that a lot of the investors in this will probably be banks. And over time, the value, it's a market kind of mechanism like LIHTC is. So over time, the credits are going to be worth more. And I think that there will be pioneers who will experiment with how to do this. And then as people get more familiar with the model, there'll probably be more resources will flow into it, and it'll create a market for this kind of work. Then I see another question. Jude is typing an answer. Let's see. So do we have other questions? Does anyone want to raise their hand?
Chris, is this the last slide of the presentation?
Yeah.
Okay. I'll go ahead and stop sharing, and then I can get back in to take a look at the Q&A. So Lisa McGovern, I do see all three or one of the three, and because I was sharing my screen, I'm not sure which slide you were referring to. Chris Siglin, do you have any thoughts on that? Or Lisa, can you add some additional clarification?
We actually don't know. I was listening to someone from LISC speculating the other day that the pricing would might be 70 cents on the dollar initially, but we really don't know. And the market would have to develop. And that's one of the reasons why we're doing this presentation with you all, is because people should start thinking about this, start talking to their state housing financing agencies about it, and educating them, because the state HFAs are going to be setting the programs for how this, setting the parameters for how this is allocated.
And Jason Jones, I was able to unmute you if you'd like to ask your questions directly.
Absolutely. Hey, guys, can you hear me?
Absolutely. Thank you.
Wonderful. This is Jason Jones, work with YouthSnap here in Detroit, Michigan. I wanted to make sure I clarified the question specifically around the gap only financing. And using the example that was on slides a couple slides ago, you got a 200K or 250K development with a 50K gap. If you're only funding the gap and any discount at all, or discount rate is applied at all to syndication, that the nonprofit developer will yield a net loss on the total development cost. So if for example, we got 50K worth of tax credits, typical syndication is 80%. So that would only yield 42K worth of cash. The concern is that we're fully funding $250,000 worth of development, but we're only getting proceeds from sale that cover 200, and then we're only getting proceeds from the tax credit that cover 42K. My suggestion is that we should consider covering 110 to 120% of the gap to allow for appropriate discount and syndication.
Actually, that's a great question. And I think that the way, a part of allowable total development costs is soft costs. So there's going to have to be a developer fee to the developers to make this all work. So, again, this is going to develop a market. And just like how, I remember people said the low-income housing tax credit would never work. And then eventually everyone figured out how to make it work. That same process is going to go on with this. And people will figure out how to bid for the credits, how the competitor factors work. And then investors who will compete for this and will have to pay more. So I hear what you're saying, but I think that it's going to work out in practice when people, because the developers will be able to get a development fee on every house. And if the houses sell for a little more and they need less credits, then, and people envision that the way this will work is that the developer will get a line of credit. And because remember, when the house sells, then the homeowner has a mortgage. So you'd probably have a certain, a pool of equity investment from your investors, and then you'd have a working line of credit from a bank. And so the house costs $240,000 and you end up with a $40,000 credit, that will come out of the pool from the investor. And then the bulk of that will be a working line of credit, which is then repaid when the homeowner gets a mortgage. So, there's going to be fees built in on all of this, and people will have to make their financial models work. But that's a really great, sophisticated question.
Excellent. And Chris, just a clarification. Jason, did that answer everything that you needed?
I think it does answer the question. And it's probably one that needs to be modeled out, which I'm happy to volunteer if that's appropriate, or if ever that's appropriate. But the point is like when you're trying to balance sources and uses, one of the key pieces is make sure that they're in balance in cash equity. And I'm not sure that only funding the gap is going to yield that, right? And that's all. I want to make sure that the project works.
Well, one of the things that we've talked about is in a market like Detroit, where the houses have really high rehab needs, there's nothing in the bill that prohibits the use of additional subsidy. So, because you're right, it's designed as a shallow subsidy of 35% of the total development costs. So you might, if there were like good community development reasons to do houses that had higher needs than that, you might have to leverage home or CDBG money along with this. So yeah, there's going to have to be lots of modeling. And actually that slide you saw of all those partners, one of the partners that I was happy about that just joined our coalition is Novogradac and Company. And they're the tax accounting folks who help make the low-income housing tax credit market work. And they are interested in the technical details and running models to see how this will work. So they're going to be good collaborators for us.
Understood. And thank you for the answer. I appreciate it. There are certainly more conversations to be had. Like in a low cost or in a low income market like Detroit, we also have concerns that 4x the AMI as a limiting factor is a problem for low income cities. So our AMI is only is 54,000. So 200,000 is a very low limit for the opportunity for the total development cost. So we've basically started building or rehabbing very small houses, which is not necessarily the market demand as well. So thank you for
Yeah, and Jason, we'll be happy to connect you with Chris offline as well. and you guys can have further discussions.
Okay,
Um,
and then I
Chris,
see,
do you see the Georgia question? So the question is, and I think this is applicable not just to Georgia, but certainly if the geography meets one of the 3 criteria, does it count? Or
No.
is it all 3?
all
it has
three.
All
So-
3.
Yeah, so that map shows you everywhere that every census tract that meets all 3 criteria.
Got it.
But then there is flexibility that with 20% of the allocation, the states can designate the credits for places that don't meet all 3 criteria if they're in a non-metro area and less than 100% of area median income. So that's the rural flexibility.
That's helpful. I think you answered this earlier. Expect pricing to be for the credit initially.
We don't know, but that's a great question. I heard someone from LISC say that they thought it'd be 70 cents on the dollar to start.
Okay.
But we'll see. I see another question. Kamala Lewis says, how does the homeowner access this tax credit theoretically? That's a great question. So how an example would work is that you've got a homeowner in Cleveland, lived in their house since the 1970s. If there is a developer in the homeowner's neighborhood who has received an allocation of these credits, I would guess the developers are going to go around and work with a neighborhood association and figure out whose house needs rehabbing. And as part of the overall plan for the neighborhood, you would work with existing homeowners to do a gut rehab, and then the investors would get 35% of the total eligible development costs would be paid for by the investors, and then the homeowner would either take out a mortgage or for the 65% remaining of the costs, or they would get grant dollars from the city to cover that cost. So the homeowners would have to work with the managers who've been allocated these credits.
Awesome.
Here's a question from Jennifer. Is there a cap on the development fee so that is not abused? Yes, the states have the ability to set limits on soft costs and developer fees, just like what happens with the low-income housing tax credit. Good question. Is there a time limit during which you have to use your allocation? You have 5 years. So that should give developers enough time to, we didn't want to make it endless, but you'd also want to give people time, because this is time intensive work to work with homeowners and get this kind of substantial rehabilitation done. So it's 5 years.
Great. It looks
Any
like
other questions? Did I get them all?
we've covered everything. You've certainly handled all the ones that we have so far. Again, I'm happy to unmute folks if you've got it looks like, let's see. Chris, it says the City of Chicago Department of Housing just submitted a report on LIHTC. I'm not sure if there's a question there or not. If you'd like to ask an additional question, or if you're just providing feedback, that's fantastic. If anybody else has a question, please utilize either the Q&A or the chat, or again, I'm happy to unmute you if you'd like to ask your question directly.
And also please email me at NCST, and I'd be happy to go over any of this and connect you with the much deeper tax nerds than myself who really answer all of these.
Wonderful. Lisa McGovern, I have unmuted you.
Thank you. And I think this is going back to Jason's question. The difference between the gap and the equity that you would be, or the tax credits that you are eligible for, is so in that example, you had that $50,000 gap. Is that equity or is that tax credits that you'd be limited to?
That would be the amount of investor dollars that you, so to make the developer whole, on the other way to, I guess, flip this around is look at it from the developer's perspective, that you put $240,000 into the house, If it sells for 190, you're going to get 190 from the home buyer, and then you're going to take $50,000 from the pool of equity you have from your investors, and then that investor gets a payment from the federal government. That's the tax.
Right.
Then
Okay, that's helpful. So it really is, it's the whatever 70 cents on the dollar. It's not the tax credits, it is the actual equity.
That's right.
Okay, thank you.
Super. And then Chris, there was another question that I think is great. How would it work for rehab then rental? Can credit be credited the first year or
No.
over time? How does that work?
Can't be used for a house that's rented.
Okay.
It's owner occupants only.
Perfect. Additional questions? Let's see. Michael's good. All right. I am not seeing anything else, although I think it's Jamila. We will take a look at all of that. I appreciate you adding that information into the chat, and we will definitely take a look at that.
Yeah, and I think, Jamila, the answer to that question is that state allocating agencies need to be thoughtful about where they prioritize for these credits to be. And there's an ongoing conversation about concentrations of rental housing in areas that are not opportunity areas. And it's an appropriate subject for debate between advocates and state HFAs and how they run the program, and to make sure that the houses are in areas where families want to live with access to good schools. And all those things are going to be criteria that states can set and that advocates should push for to get the best outcomes for this.
Yeah. And Chris, a couple of more comments from Jason. In order to make developers whole, considering sales costs, net sales proceeds very different from the gross sales price. So just
that's an interesting thought.
Yeah. Let's see, will there be further training on this tax credit and how to go about using it in the most effective way?
First we got to get the thing passed. We want this thing passed and signed into law, but then we're starting to think about what we do to work with. One of our partners in this effort is the Trade Association of State Housing Finance Agencies, and we definitely are. The states are going to have to do training for developers, and we're also going to figure out how to get the states themselves trained to do this well. So all of that to be determined.
Wonderful. And Linda, yes, the presentation will be distributed. It will be on our website, most likely tomorrow, but we will send out a follow-up.
And the credit is not mostly for urban areas. I mean, it can be used in both urban and rural areas. It's anywhere that is eligible on all three criteria, any census tract.
Awesome. Well, thank you so much, Chris. Clearly a lot of questions around this, which is great. And we look forward to the time when we can announce that this has passed. Long time coming. All right, wonderful. With that, I will turn things over to Julia Gordon for a policy update.
Thanks, Erin. And Chris, thank you so much for that presentation. That was a great conversation. A lot of really fantastic questions that we heard. I will note that, what happens with legislation is, you work on something and you get it all ready, and then you put it into a bill, and then there's a lot of conversation, and you don't know what will be changed or adjusted. And I just want to strongly recommend that all of you who ask these great questions stay really, we'll keep you up to date on the progress of this legislation, but absolutely reach out to us if you want to be more involved or have some questions that you want to discuss in a less time limited format. There, there is in this bill a 10% set aside for nonprofit developers. And we're going to need to make sure that the developers are out there to take advantage of this, and that it not just be it would be nice if it were not just the really, really big 600-pound gorilla developers that were able to get involved in this. And there is some thought beginning to, and of course, there's the 10% set aside, but there's no cap. So the more nonprofit developers or mission-focused developers are involved in this early and paying attention to it, I think the better positioned we will be to make sure that the benefits of this not only flow to the communities in the form of reduced blight and increased move-in ready properties for homeownership, but also that there is a benefit for those developers who have always been in this single family space in these more disinvested neighborhoods. So we're thinking about that and would love your input on how you're thinking about that, how we might be thinking about that, how we might be providing more technical assistance to NCST's community partners, on this topic. So I'm going to move from legislation that hasn't happened yet to talking a little bit about legislation that has happened since the last time we talked. Of course, the most important, not only the most important thing that's happened since the last time we talked, but arguably one of the most important bills that's passed in a really long time was the American Rescue Plan that puts out $1.9 trillion to protect families, communities, and our economy overall from the damage that's been done by the pandemic, and to advance the interest that President Biden tends to say in all of his speeches of building back better, of trying to invest in people and communities such that in recovering from the pandemic, we recover in a way that advances racial equity, that increases resilience to climate change, and that provides for a more broad-based, economic advantage to rebuild the middle class. And so, a very important piece of legislation. The NCST, not surprisingly, was most involved as related to housing specifically. As I'm sure many of you have heard, in addition to additional funding for emergency rental assistance, this bill included $10 billion that will go out through state HFAs to help preserve homeownership for homeowners who have been affected by COVID. And the importance of this funding is, really can't be overstated. There are many, many people who have been affected by COVID whose homeownership situation is not one that has been able to be helped all that much by the CARES Act forbearances. Those are, the forbearance program has been incredibly invaluable for people with mortgages and for people who have a loan that is federally backed. About 30% of people with mortgages don't have a federally backed loan. And then, of course, you layer on top of that people without mortgages, but who still need to pay their property taxes and insurance. And you can see that there's much wider need than was addressed just by the CARES Act. So this $10 billion, which is, relative to previous programs, a good amount of funding, will give states the flexibility to try to figure out who is in trouble on the homeownership front and how can we help them. Does it mean helping with, property tax payments? Does it mean helping even those who may have a forbearance meet their utility bills at this time? Does it help folks who may have a reverse mortgage? seniors, other people who are not really being helped by the forbearances. So I want to encourage everybody who has if part of your work relates to home ownership, I really want to encourage you to be in the conversation with your state housing agency. The Treasury Department is in the midst of writing rules now, or guidance about how this money will get out, and sort of overall rules regarding eligibility and reporting. But my belief, having been involved in the Hardest Hit Fund program and other efforts after the financial crisis, is that hearing from members of the community who are in the homeownership business is going to be incredibly important as these agencies figure out how they're going to deploy this funding. In addition to the housing funding, there was also a very big slug of funding for CDFIs that will also be going out through Treasury. Again, if you are a CDFI or if you partner with a CDFI, you'll want to be really paying attention to that conversation to make sure that the funding that's coming from Congress is going to be deployed in a way that's usable and effective for what you're trying to accomplish. So that was the big news on legislation that's already happened. What's coming up that matters to us? Well, the big thing everybody is talking about is some kind of infrastructure bill. Historically, the infrastructure bills cover, roads and various transportation issues. Will it also cover housing? I think there is a growing consensus that housing is part of infrastructure, particularly when you think about our aging housing stock and how that the condition of the physical properties relates to community health and well-being, broadly stated. So, lots of folks are advocating to make sure there's some housing component in the infrastructure bill. The Neighborhood Homes Investment Act that you just heard about, so there's certainly a big push to have that included. Representative Marcy Kaptur from Ohio has introduced a bill called Restoring Neighborhoods Left Behind that would be a subsidy program, almost like an NSP style program designed for more distressed areas, those areas where that market rate development may not be happening. There will be a push to have that included in the bill. And just generally speaking, I think there is an interest in making sure that new ideas related to community development and home ownership and the supply of affordable homes in high cost areas, as well as the condition of affordable homes in areas where there might be more vacancies, that both of those things are addressed. On the regulatory front, there's a ton going on right now, both in terms of, as I mentioned before, implementing the stimulus bill, but also in terms of the foreclosure prevention and the eviction protections. So you see most of the action right now is there's a lot of focus by the White House itself on these issues. The CFPB is newly invigorated and is looking very, very hard at what actions they can take under their authorities to help protect both tenants and homeowners from eviction. And HUD, as well as FHFA and Fannie Mae and Freddie Mac, are working very hard on trying to improve the system that homeowners who went on forbearance will encounter when they come off of forbearance, so that they are able to quickly and fairly painlessly deal with their arrearages and get back into a situation either where they are paying the same mortgage monthly mortgage payments that they were paying pre-crisis, with the arrearages held in a second lien that has no interest paid on it, and is paid off when the mortgage is paid off, or getting people into loan mods that will capitalize those arrearages and spread the payments out over a longer term, reduce rate when possible, to try to get people's monthly payments even lower than they were prior to COVID, because we know for so many people, their incomes are not coming all the way back right away. So I'm going to stop there and see if there are any questions or other topics that people want me to provide. I see a question here regarding fully funding Section 8. Absolutely a very, very big part of the dialogue. And I think it will continue to be part of a dialogue. We've seen no particular backing down by the administration on the commitment to rental assistance. A lot of the focus right now is more on that emergency rental assistance and making sure people's rents can be paid so that as eviction moratoria expire, we don't see a wave of eviction. We know there are about 10 million tenants right now behind on their rent. I can't, possibly overstate the degree of decimation to communities if all of those people were to be evicted. It would be absolutely devastating. The administration is really laser focused on trying to make sure that doesn't happen at this point.
There's another one here, Julia. What about HUD 811 or 202? Any change to those programs will come back? Any chance, I bet, those programs will come back?
So, again, all of this is part of the dialogue. As another development since we last talked is we now have a confirmed HUD secretary. So that was pretty exciting, because I will admit a lot of the more proactive agenda at HUD, as opposed to the COVID response, it's hard for that to get underway before you actually fully staff the agency. So, we have a secretary in place now. We expect a deputy secretary will be nominated relatively soon. And then you'll start to see assistant secretary nominations come through. And as you get that political staff in place, that's where a lot of the plans that were developed during the transition period can really start to be moved proactively.
Great. Michael's asking about money carved out for CDFIs. Any more specifics on purpose of its use?
So I'm going to actually kick that question over to Chris Siglin, who's been pretty involved in that conversation. Chris, you still here?
Yes, there are two different pools of funding for CDFIs in the COVID relief bill. One of the pools is going out by just existing grantees just get an additional tranche of it, and that's going out right now. It's called Rapid RR something. Then there's another 1.75 billion for minority depository institutions and CDFIs that serve minority communities that the CDFI fund is working on regulations for right now. And that's a really, the Homeownership Alliance, which is a project at NCST to working with a group of nonprofit housing developers to advance the policy agenda, has made some suggestions to the CDFI fund about using that money for CDFIs that work in majority minority neighborhoods for homeownership lending to both build equity and fill the racial wealth gap.
Fantastic. All right, I am not seeing additional questions. Oh, I do have a, Michael, I've unmuted you. Michael Roberts.
Yes, Aaron, Chris, hi, Chris, how are you today?
Hello.
Hi, we deal with the CDFI, and that's what prompted me to ask that question. So thank you for answering. I think you've kind of answered it, and I'll reach out to our contact at the CDFI for their purpose and see how we can help within the community.
Yeah.
Wonderful.
That's great.
Any additional questions from folks? Here we go. State funding, particularly funding in Florida, is disappearing. Any opportunity for federal GRAP financing to end buyers or additional home funds? Not sure which one of you wants to take that on.
Actually, I mean, all of those questions are going to be resolved in the budget as the budget proceeds in Congress. So as cabinet secretaries are in place, we haven't had a budget proposal from the president yet, but once the officials get in place, we'll have that. And then Congress is going to have to do its work. And there's a letter going around to increase funding for the home program. And so, yeah, that is really important as states struggle with shortfalls. And we'll know by the end of the year.
And I'll just add, I'm not sure if end buyers refers to owner occupants, but there is a very robust conversation in Congress on both the House and Senate sides right now concerning new down payment assistance programs, and specifically bills to create a big new federal down payment assistance program that would be much more targeted than previous programs. The targeting that's really being discussed these days is different from previous types of targeting we've seen, in part because a lot of the focus of this conversation right now is on racial equity in homeownership and trying to use homeownership as a strategy for reducing the racial wealth gap. So the type of targeting that's under discussion now, that's really an innovative conversation and a very interesting one to be part of, is whether you can target that funding to what people are calling first generation home buyers, meaning people whose parents did not own a home. Again, that is much more, it's much more likely for a person of color to have parents who didn't own a home than for a white person to have parents who didn't own a home. And that kind of targeting could be a way of really directing those down payment assistance funds without running into what some people are concerned about, which is if you have a down payment assistance fund that is targeted specifically by race, whether that's something that could pass by the current configuration of the Supreme Court. So looking for these other indicia of people who may be locked out of the homeownership market because of, what I often call the lack of being able to go to the bank of mom and dad. This is a really interesting new development, and I'll keep you posted on that.
Thank you.
We are at the end of our time, and I'm seeing that we've answered all the questions. I appreciate the lively discussion today. This has been fantastic. Love to see all of your questions. As a reminder, we do hold these calls once a month on the third Wednesday of every month. Our call on April 21st, we will have a guest from Purpose Built Communities. Her name is Mickey Anderson, and we look forward to that chat. In the meantime, if you'd like to reach out to us, please feel free to email any one of us. You can also reach us at buyer@stabilizationtrust.org, and we can route your question to the right person. Any closing comments, Julie or Chris?
Well, just thank you for the great questions about the Neighborhood Homes Investment Act. You guys are really, I've given this presentation a lot, and you guys are a very sophisticated audience. Thank you. And please do, if you have further thoughts, reach out.
And I just want to thank you all for being here. I hope spring springs soon for everybody in every geography. I hope everybody gets their vaccines soon, and that we see the world go back to normal. We all could use a break these days. So thanks for hanging in with us.
Right, thank you.